Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Tineke Frieke, manager of the Smith & Williamson UK Equity Income Fund. Hello, Tineke.
Hi there.
So I had a look at your fund's portfolio and there's about 8.5% in energy stocks. The top two holdings of the fund are BP and Shell. And I thought that was really interesting because a lot of UK equity investors have been scared off this sector, in particular those looking for yield. So why do you continue to find it compelling?
Earlier this year, I had a sense that we were in a more stable range, maybe somewhere between 40 and 50. As we sort of approached the second quarter of reporting, we sort of start to think about the third quarter of reporting, and we kind of nearly close to the oil price level where we were a year ago. So that sort of gave me a little bit of comfort that maybe we're getting close to stabilization in the earnings. So from having no oil, I went to 8%. I might have even ticked slightly higher in that on BP and Shell. High dividend yields, still not without risk, because certainly at the moment, and both stocks have reported last week, earnings are still going down, debt is going up, but the shares aren't particularly expensive from a price to book, and the dividend yields for now, for this year, they look fine, but that's certainly something that I think has scared off lots of equity income investors, because we obviously want yield and is it sustainable? Both companies will need the oil price to get to 60 to start sort of having a sustainable level. But for now, I was sort of happy with the risk-reward profile. Saying that the stocks have performed very strongly. Both these names have sort of gone up about 30%.
And oil did make up quite a stable part of the sort of income world for some time. For a long time, you know, oil stocks and banking stocks were the backbone of any good income portfolio. Yeah. Then we entered a period where both those sectors cut dividends either, you know, down or entirely. So would you say that as an income manager now, you have to be a lot more active than perhaps you did in the past following the global recession and the oil price fall?
Yes, overall, I think, yes, being active has a big advantage in a more volatile stock market. And that's sort of regardless of what you just touched on, because you're absolutely right. The banking sector was sort of the top income sector in 2007. The big oils haven't cut dividends, but certainly the more oil exploration companies have cut, and it's because they don't have any free cash flow. Yeah, so if you don't make any money, it's very difficult to pay the dividends. But it's absolutely key to avoid stocks that cut, because they tend to do this out of distress. And we've seen a lot of cuts in the mining sector, which good fund manager could have seen that coming. You could see the net debt rising and the cash falling, and that's just not sustainable. My fund has no mining stocks. I still think that the risk reward isn't right there. But overall, I think it is important to diversify where your dividends come from. The big oils and some other large UK stocks are helped by the dollar, so we're at about 133 to the dollar, so a strong dollar. Companies that declare dividends in dollars, you get a little bit more bang for your buck in the sterling, but that's not always the case. So I think being nimble is important to diversify your income, but also get that risk reward right. Otherwise, you might just be in too risky stocks.
Tineke, thank you very much. This is Emma Wall from Morningstar. Thank you for watching.